Okay, welcome back. Markets bounced from the day's lowest point and, of course, doing quite okay now. Broader markets are doing even better because that's essentially where the problem and pain has been. Market breadth is looking positive. Now, regulatory action and governance on financials are in the spotlight today. A bunch of actions have come through recently, and to discuss all of this, we have Abizer Diwanji of EY India and two former Deputy RBI governors, Anand Sinha and Mr. S.S. Mundra. Gentlemen, great to have all of you here. Appreciate your time. Mr. Mundra, if you can start by asking you, sir, on something that we reported. This is, of course, source-based information, but my colleague Sapna from Delhi reported that the government is asking PSU banks to review gold loans. They essentially are saying that there are instances of non-compliance of regulatory norms as specified by the regulator, by the government. So just wanted your thoughts on this one, sir, to begin and kick this off.
Sorry, I think I have little connectivity instability. I missed your question. I'll try to switch to another. Meanwhile, can you start somewhere else?
Yes,
I'll just try to correct it. Yeah, please.
Okay,
please.
Okay. We'll do that while you sort of come back with us. Let's actually bring in Mr. Anand, who's with us, Mr. Sinha, who's with us as well. Mr. Sinha, same question to you if you want to respond. The government looking at gold loans by PSU banks pretty closely now. This is, of course, sources sources to CNBC-TV18. Companies we've spoken with, I mean, traditional old gold loan companies like Muthoot in the private sector have told us that public sector banks coming in the space has raised competitive intensity in a very large way. This is the feedback which has been there for the last year and a half or so now. How would you look at this, sir, in the context of sort of, general, regulatory and compliance-related measures which have increased over the last 1 month or so? Go on, sir.
See, as far as gold loans are concerned, there have been some problems in the NBFC sector, gold loan companies. We are aware of that. Now, in the case of public sector banks, what exactly is the concern? I'm not aware of. But one thing I can say from a regulatory and supervisory perspective, that when any portfolio expands at a rapid pace, it's a red flag for regulators because invariably a large expansion and a fast expansion is accompanied with weaknesses developing in control systems. So could be that could be a concern. And exactly what is the concern now? As I said, I really don't know. But if the portfolio is expanding rapidly, then certainly it becomes a matter of concern. It does not mean necessarily that things are wrong, but it certainly means that one should have a look on the control systems, on the appraisal processes, on loan sanctions, and ensure that the system is fit to deal with this kind of expansion.
No, I mean, the pace of expansion of gold loan portfolio has been very, very fast, right? But I mean, for many of these PSU banks, the base relative to their own balance sheet size was small, but now, of course, it's become much bigger. Some of the aspects which we've been told is banks have been asking to fix anomalies with respect to gold loan disbursement without collateral, with respect to collection of fee, interest, closure of gold loan accounts, etc., and also with respect to repayment in cash. These are some of the specific points, Mrs. Sinha, which the RBI is talking about. Mr. Mundra, if I can bring you into the conversation. Mr. Sinha telling us that when a particular segment grows very fast, it is usually accompanied by things which are left out, things which are not done properly, and the regulator steps in and takes a closer look. Your response, sir?
Yeah. So, first, of course, I'll pick up from where Mr. Sinha left. That is true. And it's simple, I am not going to a particular segment, but even if you take at the industry level, you see, if you take last 3-4 years, the average credit growth in the system was around 15%, whereas the growth in unsecured loans was on the side of plus 30%. So I think that is one itself is a very broad indicator that certain segments need to be relooked into. Coming to specific, whether it is gold loan or it is any other action which has taken, from whatever I see and hear so far, let me put it like this. I don't think that it was at the governance level that thing would have gone wrong or indication would have gone wrong, but it is certainly a reflection of lack of control. And I can speak from both the perspective, the practitioner's perspective and regular's perspective. When I say more control, see what happens ultimately in an organization, then there are certain units are there which are operating at the ground level, then there are targets, and always, there would be a communication and pressure to meet the target. And in the process, at operational level, I think many of the controls which should have been exercised, they are allowed to be relaxed. And then things come to this level. By the time they are noticed, sometimes it is, in a very initial stage and you can control them. Sometimes it has become quite big. So at that point of time, even if regulator is asking them to correct them and giving a deadline, actually in practice it becomes very difficult. So you will see both the things. Regulator, see in all these cases, you would have seen that regulator has been engaging with the entities for quite some time. It's not a very sudden action, but despite that, things have not happened. And this is what at the ground level which contributes to this.
Got it. Let's get Abizer Diwanji into this conversation as well. Abizer, a lot has happened, right, in the last fortnight. I mean, the RBI has come in and tightened the screws on several sectors, whether it's gold loan financing, whether it's loan against shares, whether it's IPO financing. Which are the other segments that you think could be vulnerable from here on? And what are the implications of all of this regulatory action?
So firstly, I think to answer your question, Sonia, which are the aspects that can still be covered? I think the larger concern is end use of loans not being known. So gold loans or personal loans, one doesn't really know where the money actually lands up. Does it land up in consumption or aspirational consumption? Does it land up in the stock markets? Does it land up in repaying other loans which are otherwise being delinquent? One doesn't know. So I think the bigger issue is going to be anywhere where end use is not clearly defined is an area where a regulator will have a concern. So I think that is the primary issue. Now, if you, continuing with what the other two the two RBI deputy governors have said, the real issue that we have on hand is the changing business model of banks. Banks have tended more towards retail and within retail towards, unsecured or where the ultimate end use is not known. Now, banks have also tended towards that. And by the way, by tending towards that, they've entered into an NBFC category. What happens when they enter into an NBFC category is that the NBFCs who actually borrow from banks have to slide a little lower down the credit scale. When they slide down a little lower in the credit scale, then they have to accept cash, then they have to mend the customer, when they have to make sure that they make certain concessions, and that is where control breakages happen. So what is happening is that there's a shift in the business model that's been happening over time. And I think that is what is the RBI or the regulator, including SEBI, are trying to grapple with. One, where the money is going and what kind of credit is actually entering the system.
Okay. Do you agree to Mr. Mundra's point that the gold loan clampdown is actually not at a governance level? It may be a more proactive measure that the RBI is taking. I mean, particularly on gold loans, you mentioned that end use is a concern. Got that? I mean, not knowing the end use of that, that loan is a concern. But what else do you think could be the primary concern here? And how do you think the way forward would be on gold loans particularly?
No, so I agree with Mr. Mundra when he says that, these are more control-related issues where RBI is trying to preempt a potential bubble. And yes, there is concern. Obviously, every regulator will be concerned where there is a potential bubble building up, and we are seeing that, right? The stock markets have melted down over the last 2 days. What will be the implication of that on loan against shares? One doesn't know. So I think a clampdown is more a precursor, a worry that the central bank is looking at. It's not necessarily fraud, but it is process-related issues that they are going to be concerned about. So I think that's only thing is that the frequency of it is causing a little bit more of an alarm. Too many things happening too quickly is, I think, what is causing the panic.
In quick succession, all right. The other thing which has happened is RBI halting fresh issue of co-branded cards at Federal Bank and South Indian Bank. Abizer, you want to take that up? That also seems to be with regards to specific entities.
Yeah, again, I don't think these are specific entities. Everything, you just look at it, they are fundamentally against co-branded cards. What RBI is saying is co-branded cards is what? It's basically outsourcing your core business. Somebody else is issuing a credit card the underlying belongs to somebody else, the customer belongs to somebody else, the bank is a booking vehicle. And when those kind of issues happen, then there is always a concern that is the bank exercising enough control to make sure that their credit is worthy. And the next step that they're expecting is that there will be overdue on credit card payments. And those overdue on credit cards, it's already happening by the way, overdue on credit card payments in the co-branded section hold a far bigger risk because the customer doesn't belong to the bank. And I think that is why it happens. And I don't think it's going to be specific. They've picked up two inspections, but it is again an area of concern that people have. Now again, I think the larger issue is the bigger bubble that's brewing up. And I was just chatting with one of these younger groups, and they were saying that we are more interested in aspirational lending now. So this whole concept of aspirational lending is actually scary, because the aspirational income may not be there for that particular segment. But if the aspirational borrowing happens, then there is a chance that there could be higher levels of delinquency.
You used the B word, bubble word. Abizer, in what segment exactly? You said, you said the bigger thing which is brewing, yeah. So,
resources are like water. Once you push it into the system, it can just go anywhere, right? It can go to the stock market, it can go to the credit markets, it can go to real estate, it can go wherever. So which bubble? Difficult to say. But I think what is to be controlled is the resource distribution. And that is what I think the central bank is aiming at.
I think that's well put. Maybe we can say bubbly, not bubbly yet, but...
People are using words like frothy and bubbly and...
All right, we'll leave it there. We wanted to go on, but we're completely out of time. Abizer, Mr. Mundra, Mr. Sinha, appreciate all of you joining us here on this quick chat today. Thank you very much for your time, and look forward to speaking with you soon again. By the way, I just want to leave with the small cap index, right? I mean, not the Nifty, not the mid cap, not the bank Nifty. The small cap index is up almost 2%. All right, and that's the rebound that we have on our hands already. Look at that. And steady kind of rise is what we've seen today. Market breadth is positive, almost 3:1. 600 down, 1800 up. So clean, neat 3:1 advances to decline ratio. The bank Nifty is slightly down about 1/3%. Otherwise, there's green on the screen. It's a wrap from all of us here. It's goodbye. Thanks for watching. Chartbusters up next.